Hi, my name is Mileto, and on behalf of Link Property Services, I am pleased to provide you a brief Q1 market update on Sydney's southwest industrial market. The uptrend has continued in capital growth for both prime and secondary grade assets, primarily due to the ongoing and significant infrastructure spending in the region. The primary examples of this infrastructure work is Western Sydney Airport and Moorebank Intermodal. Record rates in values has been an indicator of the positive effects made by future planning in these key infrastructure projects. Population growth and a strengthening domestic economy are also key driving factors in the continued development of Sydney's southwest. Indicative of the population growth rate in the region is that of Liverpool City, currently running at an average of approximately 2.5% per annum over the past 5 years, as opposed to the Australian growth rate of approximately 1% per annum. Due to this population growth and major infrastructure projects, we see a further positive outlook for rental growth over the medium term as prime and secondary rents continue to climb. Growth in the southwest corridor for secondary stock is also being fueled by extremely low levels of available property. Demand has continued to outstrip supply, resulting in healthy competition for a number of available properties. Both sales and leasing rates are projected to continue in an upward trend as construction of major infrastructure projects progress, coupled with Southwest benefiting logistically due to transport-related infrastructure such as the Moorebank Intermodal, WestConnex and M12 motorway, connecting the Western Sydney Airport to the M7 motorway. Sales rates between $1,600 to $2,300 per square metre have recently been achieved for secondary industrial buildings, with prime office warehouse buildings achieving $2,500 to $3,800 per square metre for the sub 5,000 square metre industrial properties. This represents an increase of around 20% since this time last year. Investor demand from institutions, consortiums and privates remains strong, with industrial assets selling at yields of circa 6%. Which we expect will remain further constrained in the medium term. The extremely tight supply of serviced land is limiting the amount of development activity, and we expect to see this shortage to continue for some time until new rezonings such as Badgerys Creek become available. Tenant displacement within South Sydney and Inner West industrial precincts also continues to drive demand due to the continued rezoning of historical industrial space. These users are being forced to follow the M5 in search of greater opportunities. We are seeing leasing rates between $95 to $110 per square metre being achieved for secondary stock, with prime grade industrial assets achieving between $110 to $140 per square metre across the southwest Sydney market. Leasing incentives are currently hovering around 10 to 12%, but we believe these will continue to tighten due to the ongoing shortage of options for tenants. Speculative developments have, however, increased due to developer confidence and has helped support the limited industrial supply over the past 12 to 18 months. Transport and logistics continue to dominate the leasing market. However, we expect e-commerce to drive tenant activity in the foreseeable future as consumers move towards on-demand consumption. We believe, due to these factors, the southwest industrial market will continue to grow in strength over the foreseeable future.